Okay, a couple of very quick reminders before I start. The first is, at the risk of repeating myself, your DCF is... It's okay. At the risk of repeating myself, your DCF is due this Friday. Okay? I've already had emails about, can I send it in at 5:20, 5:30? Just send the damn thing in. I don't care whether it's 5, 6, 7, 8, 9, or 10. It's for feedback. Okay? It's not like I'm going to do this on Friday night. So that's not actually a bad idea. I might try to do it. But I would try, as I said, to get it back to you. And the feedback can take one of three forms. The first and the best case scenario for you is I look at it and say, everything looks okay. You're all set to go. The second is, and this is more common, is I will send it back saying, take a look at the comments, and in the spreadsheet I'll actually put in my comments on the numbers that I either don't understand or I think might need to be taken a look at. And the third is the most disastrous scenarios. I'll send it back to you and say, I don't even know where to start, which basically means that there are such fundamental problems. And I'll kind of point out what I think are the fundamental problems, which means rather than fixing the spreadsheet, you might be better off just building it from scratch, because it might be just that you've used the wrong framework to value your company. So I'll try to get it back to you as soon as I conceivably can, and that might be Friday, it might be Saturday, it might be Sunday, but I'll try to get it back before the weekend is done. Okay? If you've checked the calendar, you know what else is coming a week from now, right? You have no idea. You've not checked the calendar. The second quiz is a week from today. Okay. It's not on? Let me increase the volume. I think it's on because I can hear the... Is that better? Okay. So the quiz is a week from today. I'll put up the review session for the quiz after class today. So you can watch the review session, go through the review. It will cover through the end of packet 1, which we are pretty much what we're going to be done with by the end of this class. Okay? Because even the stuff we won't get to by the end of the class is really not stuff that's testable. So it's really the stuff through the end of this class, which means it's everything from growth on, because we did discount rates and cash flows for the first quiz. It'll be growth, the full DCF valuations, all the little details about dealing with management options, cross holdings. That's nice territory to go check out whether the details stuck. So that's the second quiz. And the rules apply that if you're not going to show up for the second quiz, you need to let me know before next Wednesday at 10:30. Anything else? On the final, the DCF, when you're turning it in, you don't have to turn it in as a group. I sent this email out, but it might not have got through because some of you seem to be blocking my emails because you're asking me questions that I asked and I answered in the previous email. You don't have to send it in as a group. Just send it in individually. Give me an Excel spreadsheet, so there's nothing to write. So basically, if you have something to ask or some comment to make, put it in the spreadsheet. It's easy enough to see, and I'll get it back to you. Okay, so let's pick up with the very last stretch of discounted cash flow valuations. Today, we're going to talk about more companies that are difficult to value, including commodity companies, financial service companies, cyclical companies. So let's start with commodity companies, oil companies, gold mining companies. We know that commodity prices move through cycles. You go back and look at 200 years of oil prices, you'll see them go up and down, it's part of the process. So I have a question about the valuations of commodity companies. If commodity prices go in a cycle, would you expect the valuations of commodity companies to stay constant through the cycle, go up and down with the cycle, or move inversely with the cycle? In other words, values go up and the price is down, values go down. So the question is, will values go with the cycle, against the cycle, or will they perhaps be independent of the cycle? What do you think? Go ahead. With the cycle? And if you believe they go with the cycle, what are you implicitly telling me about how markets behave? Or that they believe that every cycle, this is the last cycle, you're never going to see a cycle again. So in fact, if markets are irrational or short-sighted, or this time is different, They might actually move with the cycle, assuming that in high oil prices, so they could move with the cycle. What has to be true for them to move independent of the cycle?
The market has to look into the long term.
And it has to do, not only does the market have to be long term, but the trend line in the cycle has to be flat, right? So prices are going to be constant. The cycle goes up and down, but the average oil price, so prices could stay constant. Could they move in the opposite direction of the cycle? Yeah, if you make some assumptions about markets and how they think about cycles, you could actually, so all I'm saying is, I all too often see people give a very easy explanation. All stocks are down because oil prices are down. If you make that leap, you're also making implicit assumptions about the rest of the world. At least be explicit about what those assumptions are, because that might become the basis for why prices are different from value for commodity companies. We're also going to talk about financial service companies. And one of the trend lines across the world, when you look at banks, insurance companies, investment banks, is regulatory capital requirements are increasing. People are worried, 2008 crisis, regulatory capital is going up. As regulatory capital requirements increase, so holding all else constant, which of the following would you expect to start seeing at banks? High return on equity, low risk, low return equity, low risk, high return equity, high risk, or low return on equity and high risk. Let's start with the return equity because that's the easier half. As my regulatory capital requirements go up, what else is changing? My book equity has to go up, right? Because a big chunk of my regulatory capital is book equity. So if my regulatory capital goes up, even if my profitability stays the same, my return equity is going to come down. What about risk? Is there a risk story you can build around regulatory capital? You want to try? What kind of risk story could you tell?
Well, there's the problem if you have a confidence problem in the bank, having that higher bar to that higher threshold could actually make higher risk.
Okay. The first is truncation risk, right? We talked about truncation risk. With banks, if you fall below the regulatory capital, all kinds of bad things start to happen to you. So the second is, for better or worse, not only have regulatory capital requirements increased, but the uncertainty about what they will be in the future has also changed, right? Because pre-2008, for a very long stretch, it was a fixed game. You knew what the regulatory capital ratio was. You knew it wasn't going to change. So when you valued a bank, you weren't worried about those changes. Today, when you value a bank, not only do you have to worry about what those changes are today, but you worry about how much they could change tomorrow, a year from now, 2 years from now. So in a sense, banks are caught in this pincer between low returns on equity and high risk. And what's that going to do to your value as a company if I lower your return on equity and increase your risk? The higher risk is going to show up as a higher cost of equity. Your lower return equity is moving in the opposite direction. We're going to talk about why banks trade at less than book value today. And in a sense, we can already see why that's happening, is they're getting the worst of both worlds, more risk and lower profitability. At the end of all of this, we're going to come up with the value for your company, right? And each of you is going to come up with the value for your company. Let's say you feel absolutely confident about your value, which is a very strange place to be, but let's say you are. Would you be willing to put all of your money? So let's say you found your stock to be undervalued. You're absolutely sure, 100% sure it's undervalued. Would you be willing to put all your money in that stock? You have no faith in your own valuation. You told me you're completely confident. What is the other half of this equation that you're not confident about? To make money, the price has to adjust the value, right? I think often when people ask you how many stocks you invest in, and you say 25, their reaction is, oh, you mustn't have much confidence in your valuation. That's half the game, but the other half is the price has to adjust to value. It's hubris to believe that not only have you got the value right, but that once you get the value right, the price is going to automatically adjust the value. Only then can you really put all your money in one stock. It's actually a very fuzzy answer to the question, how diversified should you be as an investor? If you're absolutely confident both in your valuation, markets adjusting, you should put all your money in one stock. The less confident you get in your valuations, and the less confident you get about markets adjusting the value, the more you need to diversify. And I'll make a statement that I think I can prove. The number of stocks you will need to get diversified in today's market is far greater than the number of stocks you needed 10 years ago, 20 years ago, 30 years ago, because the world is becoming a more uncertain place. Markets are becoming more unpredictable. And the more unpredictable they get, the more you have to hold in your portfolio. Not because you don't feel you can invest, but because you need to spread your bets. Okay, so here's the final question. Let's say you decide to drop out of business school. This is too much work, valuation, DCFs. You decide to go to weather forecasting school. I don't even know whether there's such a school. So the school, they teach you how to have nice hair, point to blank walls, get the right state. I mean, yeah, there are skills you need. And you graduate at the very top of your class. And your end game in this is you want to be a star weather forecaster. And you have 2 job offers. One is in Honolulu, Hawaii. And the other is in Epping, North Dakota. I don't even know where Epping is. I have no desire to know. I'm not going to go visit and find out. But 2 very different job offers. I'm going to give you some background on why I picked those 2. Honolulu, Hawaii has the most predictable weather in the United States. In terms of weather ranges, if yesterday was a dry day, tomorrow is going to be a dry day. Epping, North Dakota has the least predictable weather in the entire country. So let me break this up into 2 parts. If you're a weather forecaster, in which of these 2 cities are you going to be more accurate? Are your predictions going to be more accurate? Honolulu, Hawaii, right? But let me ask you a second question. In which of these 2 cities are you more likely to be a star? What do we mean by star weather forecaster? You're on the news all the time, right? If you go to Honolulu, Hawaii, my guess is you will never get on the screen. You'll be delivering coffee to the other guys, because everybody knows it's going to be 83 and sunny tomorrow in Honolulu, Hawaii. And I'm just guessing, guess what? I'm probably going to be pretty close to the truth without checking the newspaper. It's in Epping, North Dakota that people will be listening to you, even though you're more likely to be wrong, because it matters more. You see, what's this got to do with valuation? We're now in the dark side of valuation, right? Difficult to value companies. We looked at Amazon last week, or last session. You look at Twitter, you look at Snap. These are difficult to value companies, right? They're like Epping, North Dakota. You're going to be wrong a lot more of the time with these companies, and you're going to beat yourself up saying, I wish I were more accurate. You value Procter & Gamble. That's like being in Honolulu, Hawaii. You're going to get the valuation more precise, but the way you make money in investing is not based on how precise your valuation is, but how precise it is relative to other people valuing exactly the same company. So that early advice I gave you to go where it's darkest, when you go looking for companies to invest in, that's based on this premise that you're much more likely to find big mistakes when you go into companies where there's a lot of uncertainty, in the middle of a crisis, rather than when you value companies where everything is stable. So let's get back to where I left you in the notes, and let's start off by talking about valuing declining or distressed companies. Again, I'm going to start off using the same framework I've used so far to set up the problem. So let's say you have a declining or distressed company, and you can put a name on it. BlackBerry, Yahoo. Let's go through question by question. I'm going to ask you, what are your cash flows from existing assets? You show me your history, right? And if you're a declining or distressed company, what am I going to see in that history? Flat or declining revenues. And your margins are probably going to be under pressure. They're going from 8% to 7 to 6. So it's not a very uplifting history. It's a depressing history. When I ask you what's your value from future growth, what's your answer going to be? You're a declining or distressed company. You're saying, what growth? You're actually shrinking. So in fact, your value from growth might be from decreasing the size of the company rather than increasing it. Then I ask you, how risky are you as a company? Because you're shrinking as a company and you're shutting down businesses, your risk could actually change depending first on which businesses you shut down, and second, what you do with the cash you might get from shutting down those businesses, because you can return it to the stockholders as buybacks, pay down debt, so you need to tell me what you do with that cash. And finally, when I ask you, when will you be a mature company, you can see the answer here is going to be in the rearview mirror, because you were a mature company 5, 6, 8 years ago. To you now the end game might be either liquidation or becoming a much smaller company that can survive in the long term. I'll tell you the biggest problem with valuing declining or distressed companies, and some of you are doing this, is a psychological problem. And here's a psychological problem. When you sit down to value a company, you feel the urge to use a positive growth rate, right? It feels unnatural to put a minus 5% growth rate. It doesn't seem like people should be doing that. You want to make this company go on forever because it seems like the optimistic thing to do. So let's take an example. When you think about dealing with decline, let's start with that declining phase. Basically, it's not that difficult. +5, -5, what's the difference between putting a sign? If you're willing to overcome that barrier to using negative growth rates, you can make your revenues get smaller. And if you think about making your revenues get smaller, what you're doing is you're shutting down businesses. I'm going to value J.C. Penney. When I talk about making the company smaller, what am I talking about? Shutting down stores, right? Think through it logically. Which stores are you going to start shutting down first? The stores which have the biggest lease commitments that are making you the least money. You're not going to start with your best stores and work down or move down them chronologically. You're going to start with it. So when you talk about shrinking, you also have to tell me what you're shrinking and what you will get from that shrinkage. Maybe by getting out of this lease, you'll get paid $2 million or $2.5 million. So it's almost, when you think about growth, rather than thinking in the traditional terms, you have to think in terms of how much am I shrinking, what will it deliver as cash flows. And you also have to think about, after I've shrunk enough, can I go back to being a steady state company? Maybe J.C. Penney, a third of its current size, may be able to survive as a retail company with a very different focus. So let's see how this plays out. This is a valuation of J.C. Penney about maybe 2 years ago, a year and a half ago. Their existing revenues, and this is a company that has had repeated attempts to get it turned around, right? They got that Ron Johnson from Apple to come around and say, turn the company around, as if there's some magic bullet that you can deliver in this business to make it turn around. And you know what? With retail, with brick and mortar retailing, what you see for J.C. Penney is more the rule than the exception. There are very few retail companies, maybe Target and Walmart, where you can get away using a positive growth rate anymore because everybody else is under assault. It's the Amazon effect. So I took the 12.5 to 2 billion, which is the revenue right now, which has been dropping over the last few years, and I assumed it will continue to drop for the next 5 years at -3% a year. So they're shutting down stores. Their margin right now is abysmal, 1.32%. I'm hoping, I'm praying that as they shut down the stores, the worst stores, that margin will start climbing back, not to some astronomical historic level, but to the median for the retail sector, which is about 6.25%. So I'm not asking for miracles. So as I reduce my revenues and improve my margins, my profits, my operating income goes from 166 million to 672 million. It's a smaller, more profitable company by the time this is all done. So that's my EBIT times 1 minus T. Now in a traditional valuation, you subtract out reinvestment, right, to get to growth, but here my growth is negative. I'm shutting down stores. And as I'm shutting those stores down, I'm going to get some cash release, not incredible amounts, from releasing that real estate that I had a hold on, either real estate I own or real estate I used to lease. So you'll see my reinvestment is a negative number. That sounds weird. What does it mean? Basically, I'm extracting cash from the business as it gets smaller. So my free cash flow to the firm each year is actually higher than my after-tax operating income because I have a shrinking business. You're saying, what if I don't get any cash flows from shutting stores down? Just make the reinvestment zero. So when you put in a negative reinvestment here, you're assuming that some cash comes back to the company from shrinking the company. I discount those cash flows back at a cost of capital. And when I start this game, J.C. Penney is a hopelessly over-levered retail company with a very high cost of debt. The cost of capital reflects the fact that it's over-levered. It's 9%. But over time, as I get these cash flows from divesting the business, I use those cash flows to reduce my debt. And by the time I get to year 10, I have a smaller, sleeker, more healthy firm that has the right amount of debt. As I said, it's very easy to do this on a spreadsheet, so take advantage of that. And on your spreadsheet, at least, make it a healthy firm. And based on those assumptions, the value that I get for J.C. Penney is $4.84 billion. But I'm not quite done. This is assuming what? that they fix themselves and become a healthy going concern, right? But they have a lot of debt in a business where everything is changing. There's a very high chance that they will not make it. In fact, I attached a 20% probability that they will not make it. In the next two slides, I'll talk about how to be specific about that. And if they don't make it, what they will get is going to be book value, okay? Or 50% of book value. So if they liquidate, they're not going to get fair market value. They're going to get a much lower value. You take the weighted average of those two numbers. The value that I get for the operating assets is $4.4 billion. From that, you subtract out the existing debt, you divide by the number of shares. But there's nothing mathematically that's different about what I've done, right? All I've changed is instead of a positive growth rate, I've used a negative growth rate. Instead of reinvestment sucking cash flows out of the business, it's giving me back cash flows. And instead of making the company larger and a going concern, I'm making it smaller and a going concern. So when you have declining companies, if you're willing to take that path, you can value a company as it shrinks pretty much. And at the end of year 10, if you feel there's going to be no going concern, just liquidate the company. Make that your terminal value. Take that liquidation value to the present value, and you've got a value for the company. Yes?
So, aren't you including twice the effect or the fact that the company is
I'm glad you asked this question. And the first place I show it is where?
So you show it on the cost of capital.
Okay. In fact, what component of the cost of capital carried it? The high leverage and the high cost of debt, right? How do we come up with the cost of debt for a risky company? What is when we say the cost of debt for a BBB rated company is 9% or 10%, we use the yield to maturity on that rating, right? How do we compute yield to maturity? We take the interest payments and the principal, and we take the price and we look for that discount rate. So when we use a 9% cost of debt, what are we implicitly assuming? That we're going to be able to make the interest payments, we're going to be able to make the principal payment. There's a lot of uncertainty, but we're going to be able to do it. You see where I'm going? When I used a high cost of debt, I was reflecting the uncertainty about making those payments, but implicitly I was assuming I'm going to be able to make them. So a high cost of debt is not going to be enough to capture that risk that I will not make it, because it doesn't factor in the actual truncation risk of if I default, the game ends. I have to liquidate right away. So that's why it's not double counting, because the cost of debt takes care of the going concern risk to debt, but it doesn't capture the risk that I will not make it. Yes?
Can you repeat why the tax rate is going up?
Well, the tax rate is actually going up simply because I pushed it towards a marginal tax rate for the US. By the end of the process, I see JCPenney as almost entirely a US company, much smaller, and the marginal tax rate in the US is 40%. Initially, they were getting some benefits from their non-US operations, but those are the ones that lose them the most money, so those are the ones shut down. So there is, again, but keep that door open. For many of you, the tax rate will go up. You know why? Because your effective tax rate today is 18, 20, or 21%, and because you can't keep paying 18, 20, or 21% forever, you should be moving it at least to a tax rate that is sustainable over time. So like every other input, you can change it over time. Yeah. You know what an S corp is? It's a pass-through entity. Basically, the entity doesn't pay taxes, but you have to pay taxes because the income passes through to you. There are two ways you can value pass-through entities. One is on a pre-tax basis. You have to use a pre-tax cash flow, but then your cost of capital has to be pre-tax, and it's a real mess to come up with the pre-tax cost of capital. You can't just do the pre-tax cost of debt. You actually have to scale up the cost of equity as well. In fact, the simplest thing to do is take your cost of capital, divide by 1 minus t. That'll scale up the cost of capital. Do everything on a pre-tax basis, you've avoided the entire issue. The other is to compute the taxes to the investors in the S corp, use that as your tax rate all the way through, and include that as your the tax rate in your cost of debt as well. So both choices work as long as you stay internally consistent. Any other questions? So now let's talk very specifically about truncation risk. As I mentioned at the start of the last class, when you value a distressed company using a DCF model, you got your optimist hat on. You're assuming that this distressed company will fix its problems and become a going concern. And most of the time, you can get away with it, right? So if you, and the threshold I use is if you're a BBB rated or higher company, a company which is investment grade or above, I'm just going to do the DCF and let the rest kind of take care of itself. But if you're a single B rated company or a CCC rated company, whether it's an actual or a synthetic rating, you can already see the danger you're exposing yourself by assuming that this company will always make it, because the market's sending a very different signal. So here's what I would suggest you do. Do a DCF valuation with your optimist hat on. So during the DCF, don't even think about distress, default, all that stuff. It'll just distract you. Finish the valuation. Then turn your attention to distress. What is the likelihood that my company will not make it? And don't forget to ask the follow-up question. If my company doesn't make it, what will I get as cash flows? Sounds abstract, right? So let me take an example. Have you heard of Las Vegas Sands? Casino companies share a commonality. They're all run by megalomaniacs. I mean, you can think about Steve Wynn, Wynn Resorts, Las Vegas Sands, Sheldon Adelson. And they megalomaniacs who value control, which is kind of it's redundant. The two go together. You're saying, what's this got to do with Las Vegas Sands? Las Vegas Sands was one of the fastest growing casino companies in the last decade. So they were building casinos in Las Vegas, casinos in Macau. You know, they had the Marina Bay Sands in Singapore. Huge, huge infrastructure investments. And I'll give you some background. Sheldon Adelson owns 51% of the outstanding shares in Las Vegas Sands. And you're going to see why this is relevant. You're building big infrastructure, big casinos. You need a lot of money to fund those casinos, right? And if you were doing this sensibly, some of that money should come from equity, some from debt, right? Because if you keep borrowing money to build every casino, your debt ratio is going to keep climbing up. You think, so what? What percentage of Las Vegas Sands does Sheldon Adelson own? 51%, right? Through the entire decade, Las Vegas Sands didn't issue a single share. And you can see why. Because if you issue shares to raise equity to build these casinos, what's going to happen to that 51%? It might become 49 or 48, which is still going to give them effective control, but not complete control. So through the entire decade, they built casino after casino, each costing $500 million, $800 million, $1 billion, using debt. And by 2007, Las Vegas Sands was this incredibly highly levered casino company. And that you could probably say the same about any of the other casino companies. And in 2007, people loved the company because it was doing really well. Then, of course, you got 2008. The bottom fell out of both the casino business and the high-yield market. And this was the valuation I did of Las Vegas Sands in 2009. And as I go through this valuation, here's what you're going to see. Not only, I'm sorry, where is that? As I go through this valuation, here's what you're going to see. You're going to see me try to fix the problems, because there are lots of problems. But I'm doing this valuation in an environment where I was reading news stories that Las Vegas Sands wouldn't make it through the middle of the year. So I shut my mind to all those news stories, and I fixed the company on my spreadsheet. By doing what? By improving margins over time, bringing the debt ratio down over time, making it a going concern, a healthy company, and I ended up with a value per share of $8.12. So that's with fixing the revenues and the margins and the debt ratio. So essentially, I've made the company a healthy going concern, and I have a value per share of $8.12. The stock was trading at $4.25. So ask me the question, which will tell you whether I have faith in my own valuation. Did I buy? And I wasn't even tempted. Which led to some soul searching, because if my discounted cash flow valuation is $8.12, the stock is $4.25, that's an immense upside potential, right? So I started thinking about what is holding me back. And what was holding me back was all those stories I was reading that Las Vegas Sands wouldn't make it. And I said, this is not complete. This is my value for Las Vegas Sands if it makes it as a going concern. The question I haven't addressed is, what is the chance it will not make it? And what will happen if it doesn't? So to answer the first question, I went to a market that's focused entirely on default risk, which is the bond market. I found a Las Vegas Sands bond traded. It was a 7-year bond trading at $5.29. If those of you familiar with bonds, they're priced around 100. So when you see a bond trading at $5.29, it's trading at an immense discount. Now, normally the way we price bonds is we take the promised coupons and the face value, and we discount them back at this risk-adjusted rate, right, which is what we talk about, the yield to maturity. I'm going to use a different ploy. Rather than use the promised coupons and the face value, I'm going to use expected coupons and an expected face value. You think, what the heck does that even mean? For you to get the coupons, I've got to be around, right? So all I did was I took the coupon each period, $63.75, and I said I will get it only if the company survives to make me that payment. And since I've adjusted the coupons for risk, I can discount these back at a risk-free rate. So all I did in my Excel spreadsheet, I had the price for the bond, I had the coupons, I had the risk-free rate. What's the only thing I don't know? The probability that the company will not make it. I used the solver function in Excel to solve for that number. And I got a scary number. The bond market was telling me, based on its pricing, that there's a 76% chance or a 77% chance the company won't make it. Basically, I solved for what that break-even point has to be, 77% chance. I'm ready now to finish my story. There's a 23% chance of Las Vegas Sands being a going concern, and the value per share is $8.12. The remaining 77% of the time, it's not going to be able to make its debt payments, and it will have to liquidate its assets. What are its assets? Lots of casinos, right? Now, if you assume I'll get fair value for those casinos, it's not a problem. But who am I going to try to sell these casinos to? Steve Wynn, and he's in the same trouble I'm in. It's a sector where one company's in trouble, you're probably going to find every other company. So when I try to sell casinos, I'm not going to get book value. So here's what I did. I went and checked to see other casinos that had become distressed. There were quite a few in 2009. Looked to see what percentage of their stated book value they got in liquidation, and they got about 50%. So I took 50% of the book value, and when I looked at the 50% of the book value, which is $2.8 billion, that was less than the face value of the debt. That's all I needed, because that told me that if they liquidated, my equity is going to be worth nothing. Sometimes equity could be worth a few cents, even in liquidation. Here it's worth nothing. My expected value for Las Vegas Sands is the $8.12 times the 23% going concern probability, plus 0, the equity value, times the remaining 77%, which gives me an expected value of $1.92. I didn't buy. I've regretted it ever since. Stock is now at like 55. Why? Because once the distress probability lifted and casinos started to make money again, that leverage that hurt him in 2009 is helping him again. But this is a feast or famine business, right? When you're doing well, your equity is going to zoom through the roof. When you're doing badly, it's going to collapse. And that's why real estate people are bankrupt one year and billionaires the next year. Bankrupt the next year because the nature of the game is when you have that much debt, swings in the value of your business, or assets in this case, can make you incredibly wealthy or incredibly not wealthy. Okay. Any questions on distressed companies? So if any of you are valuing a distressed company, just do your traditional DCF for the moment, right? So if you get a chance to think about the probability that they will not make it before Friday, go ahead. But if you don't, just start thinking about what that number will be and what you will get if you don't make it, because that will complete your valuation. Now let's talk about emerging market companies. Again, let's go through the, yeah, go ahead. Mm-hmm.
What about if you don't think that they are going to accomplish like covenants on the debt or something like that?
It's the same thing, right? Because then it'll basically mean that you're going to have a restructuring talk with the lenders, and they're going to extract their pound of flesh for not meeting the covenants, and that pound of flesh is going to come out of your equity and my equity. It might not be as catastrophic as complete distress, but you then have to attach a probability to that and ask, how much of my equity will I have to give up? Right? Because that's effectively what the lender is going to demand. He's going to give me 50% of the shares. And in extreme cases, he might just take your entire equity away in return. Okay. Let's talk about emerging market companies. Again, let's go through question by question. When you look at the cash flows from existing assets, one of the biggest issues you're going to face with emerging market companies is it's almost impossible to find standalone companies. They have entanglements, cross-holdings, all this stuff coming with them. So that's going to make it more difficult for you to even estimate what your cash flows from existing assets. If you add on top of that the fact that some emerging markets have very opaque accounting rules, it gets even more difficult. Luckily, the second problem is becoming a smaller problem over time, because as IFRS kind of spreads its wings, you're seeing more and more countries kind of use the same standards. When you look at the value for growth, again, because you have an emerging market, the value for your growth can go from positive to negative through no fault of your company. Why? Because if you are in an emerging market, say Venezuela, you are a really well-managed company 5 years ago. well, guess what? You don't look that good now, and it's really not your fault. The countries become more risky because of macro developments, and that's affecting your valuation. And the same thing can be said about the cost of capital. Your cost of capital, your beta can stay the same. You might do everything in US dollars, so your risk-free rate is not changing, but your risk premium can go from 7% to 17% if that particular emerging market kind of implodes. And finally, when you look at steady state, if you have other risks to worry about, especially if you're in a market where you could be nationalized, where regulatory changes can render you as having no value, that's got to be brought into the process. So things you don't have to worry about with global companies set in developed markets could become a factor in emerging markets. So let's start with a few lessons I think are useful to remember. It is true that when you look at emerging market companies, country risk is a factor. But it's also true that when you value developed market companies like Coca-Cola, country risk is a factor. So country risk is not just a factor you should be worrying about just with emerging market companies, and you should not use the bludgeon approach. You know the bludgeon approaches, right? I give you a Brazilian company, use the Brazilian country risk. An Indian company, use the Indian country risk. Do what you did with every other company. Look at the breakdown of revenues and look at where their risk is before you compute an equity risk premium. So here's an example. It's a very old valuation of Embraer. Embraer, of course, Brazilian aerospace company. And the one thing I want to emphasize here is even though it's a Brazilian company, it's not that exposed to Brazilian country risk for a very simple reason. It got, at the time of this valuation, it got 97% of its revenues outside Brazil. Embraer sells those small jets that you're on for short flights, 97% of its revenues. When we did our earlier analysis for cost of capital, if you remember, I computed a lambda for Embraer based on the fact that it wasn't that exposed to Brazilian country risk of 0.27. And the way to read a lambda is to think of it just like a beta. A lambda 1 means you're as exposed as the average Brazilian company, but a 0.27 lambda suggests they're only 27% as exposed because they get so much of their revenues outside the country. You bring those factors in, my US dollar cost of equity for Embraer was actually very similar to my US dollar cost of equity for Boeing. That might sound strange. You see, one is a Brazilian company, the other is a US company, but because they competed in the same marketplaces, sold to the same airlines, their costs of equity were not that different. In the cost of debt, Embraer did pay a penalty, right, for being a Brazilian company. And part of the penalty they faced was when they went to borrow from a bank, the bank said, okay, you're a Brazilian company, you have to pay a higher interest rate. And we talked about this in the context of cost of debt and bringing in a country default risk. So country risk does show up in my discount rate, but not in an overwhelming way. This is a company that's a Brazilian company that evades a lot of the country risk because of where it does business. With those discount rates, the value that I got per share was about $9.53. And it's a US dollar valuation, so there are a few other mechanical issues you have to deal with. Because I'm doing my discount rate in dollars, my cash flows also have to be in dollars, right? Let's say that Embraer's management gives me nominal REI forecasted cash flows for the next 10 years. Help me out here. We've gone through this, but let's make sure we get this right. If I get nominal REI cash flows for the next 10 years, but I want to convert them into US dollars, because I want to make sure I'm being consistent, how do I come up with those dollar cash flows in future years? What do I need first to go from REIs to dollars? I need an exchange rate, right? I know today's exchange rate. That's the only number I know. How do I come up with those future exchange rates to use? You want to try? You have to use exactly the same inflation rule that we use with risk-free rates. If the inflation rate in Brazil is 9% and the inflation rate in the US is 2%, you have to assume that your currency will depreciate, your currency being the REI, will depreciate roughly 7% a year. It's called purchasing power parity. Why do you need to do that? Because if you don't do that, your valuations are going to vary depending on which currency you do the valuation in. You're not even saying it will happen. You're just saying, I want to make sure that I'm valuing Embraer and not taking a point of view on the strength or weakness of the Brazilian REI. And this is the only way to ensure that. So when I do my dollar cash flows, if I'm not doing it as dollar cash flows in the beginning, I have to use expected future exchange rates, not today's exchange rate. And that's basically the point I want to emphasize. If you do a valuation of an emerging market company in a currency, just for your own peace of mind, try it out. Take that same company, do everything in a different currency. So if you did everything in rupees, do the valuation in US dollars. See if you can get the same answer, because if you can do that, you are then equipped when somebody says, why did you value the company in this currency? You can point out to them that changing the currency by itself should not affect value. Because whatever good you get by changing the currency in your discount rate, you will exactly offset in what you lose in your cash flows. The key is to make sure your inflation assumptions match up what's in your cash flows and your discount rates. And we talked about this at the start of the last class. We talked about corporate governance. I mean, let's not act as if US companies are incredibly well governed and emerging market companies are not. Even in the US, there's a huge spectrum of governance. Take a look at Tesla, right? Awful governance. So, but in emerging markets, governance issues get embedded into companies and they're taken as par for the course. In what sense? I just gave you my valuation for Embraer. Until about 10 years ago, if you'd looked at any Brazilian company, any of them, every single Brazilian company had voting shares and non-voting shares, common and preferred shares. It was par for the course. It was built into the system. It's only in the last decade that Brazilian companies even have this option of issuing one class of shares. So in emerging markets, that factor often is part of the game. It is more the rule than the exception, that your company not only has bad corporate governance, it has no corporate governance. You're investing in a Chinese company, you have zero chance of how it's changed. And we talked about whether you should attach a discount to a DCF for this change, and we said, no, if you've already built it into your cash flow. So I'm going to give you an example of what I mean by building it into your cash flows. This was about 15 years ago. I was back on a visit to my hometown in India, and family group company. It's been around a long time that my father, my grandfather had been associated with. Somebody in that company called me up and said, look, we're trading at 3 times earnings. We think the market's completely missing the value in our company. Can you come in and do a valuation of our company just to show the market, as if I have that much power to move the market, that they're wrong, that we should be trading it more. Company was called Tube Investments. It was this mix of different businesses, family-run company, but a publicly traded company. So I came in and I looked at their numbers, and they were a company that was profitable but was putting everything plus more back into the business. So they were making money, but their reinvestment rate was more than 100%. You're saying, okay. So they're being aggressive about growth. That reinvestment rate in the most recent year reflected some acquisitions they'd done, so I cleaned up for it. I used a reinvestment rate of 60% that was more reflective of the past. And then I looked at the return on capital they were making on those investments, and it turned out the return on capital was about 9.2%. Now, one of the problems with having a US dollar-centric view of the world from 2016 is you look at 9.2% and say, that's pretty good. But this was an Indian rupee valuation in the early part of the last decade. Their cost of capital was 16.9%. Already you can see how this game is going to unfold, right? They're aggressively growing by doing what? By acquiring or taking projects, earning about 7% less than the cost of capital. You're saying you should fix it. Fix it how? This is a family-run company. They're running it because they think this is the way it should be run. So I kept it locked in, not just for the next 5 years, but forever. That sounds extreme, but that's the essence of governance, right? If they think they're doing the right thing, and they thought they were, they said, we're making money. What's this big deal? You're not making enough money. You build in those assumptions. The value that I got for the equity was about 15 billion rupees, which translated into value per share about 62. Stock was trading at 102. Oh, you remember why they called me, and they wanted to show the market that I said, you know what, the market's being really kind to you. You should really be trading at 62. And and initially they came back with, oh, that's because you underestimated. So one manager actually put up his hand and said, why don't you make the reinvestment rate 113%? I said, okay. So I went to the Excel spreadsheet, changed to 113%. What do you think happens to the value per share? I reinvest more and I keep the return on capital fixed. The value per share went to 45. They said, that's not working. Why don't you make the growth rate forever 9%? Not a problem, I'll make it 9%. But remember, you're still making less than your cost of capital and your terminal value if I increase the growth rate while you're earning less than the cost of capital. So anything they tried to do, but that was their first reaction. If we can go for more growth, our price will go up, right? No, your bigger problem here is not that you're not growing, but that you're growing badly. So it took about 30 minutes to get past the denial. And finally we decided that we knew what the problem was. Wasn't that you were reinvesting enough, it was that you were reinvesting in places and not earning enough. Now the problem is the investments you've already made, the sugar mills you bought, and you're kind of bound by them. You can't adjust it. So I said, let's start with the easy part. On new investments, can we start off by requiring those investments to make the cost of capital? Let's forget about the old ones. If you can just fix the return on capital on new investments, the old investments you're kind of stuck with. Here's how it's going to pop up. When I do my return on capital, let's suppose you push it up. You're not able to push it up all the way to 16.2%. But at least let's say you push it up halfway there. If you can improve the return on capital to 12.2%, not quite good enough still, then you can already see the value starts to move up. It's not the reinvestment rate you have to be messing with, the return on capital. If you can make the 12.2 to 16.2, the value jumps to $140 per share. In fact, it's not the growth they should be worrying about, the quality of the growth. In fact, if you can fix both the marginal return and the return on existing projects, which is tougher because that means pushing up the earnings on existing projects, then the value goes to 111. So the more you can improve your return towards your cost of capital, the higher the value becomes. So what you need to sometimes do is step back from the growth focus. If your value is low, don't keep tweaking and pushing the growth rate up, because it's not going to help you if your return on capital is less than your cost of capital. You have to ask the question, why is that happening, and is it fixable? It might not be, in which case you have a very depressing valuation. You should in fact shrink the company and make it look like JCPenney. So when you talk about governance, in this case, when I valued Tata Motors with the existing return on capital and reinvestment rate and got 62 rupees, that's already discounted for governance being bad, because I'm assuming I cannot change a single thing about how this company is run. We've talked about cross-holdings, right? How they create a mess. With emerging market companies, they're again more the rule than the exception. So I'm going to start off with a question. Most emerging markets, you go to India, you go to much of Asia, most of Latin America, not so much in Europe because the markets have evolved. You'll see that these are markets that are dominated by family group companies. Families have dozens and dozens of companies. I talked about the Tata group in India, but they're not alone. There are about 10 or 15 big family groups which control 30, 50, 80, 100 companies. So I have a question. Why did family group companies evolve? I mean, what are the factors that made them grow and become such a large part of these economies? What is it? No capital markets, so in a sense you had to create an internal capital market. The first reason for family group companies, the Tata group is in 100 different businesses. It didn't start off with 100, but basically over time, with no external capital market, they had internal capital. So the first reason was capital. What else? I'm going to throw out a word, and you can fill in the rest of the story. Connections. What are we talking about? Many of these emerging markets, to start a company and run a business, you needed to get licenses, regulations, approvals. And guess what? If you have ever been in an emerging market bureaucracy, knowing who to talk to and when to talk to them is in fact a huge competitive advantage. And these families knew the people to talk to. So if you wanted to start a steel plant, it was much easier if you were part of an established family group than if you were an entrepreneur. Second is connections. And the third is culture. Let's face it, it's easier to have a common culture in a company if a family is enforcing the culture than if it's than a CEO, right? CEOs pass on, families, and that culture, if it's a good culture, then can then permeate the entire company. So it's connections, capital, culture. That's a good side, the sunny side of family group companies, and that can work into your favor, right? So family group. But you can see that those three pluses can very quickly become minuses, right? The connections can become cronyism. In other words, if you look at the businesses you're in, you tend to go to licensed, regulated businesses, and you're succeeding because you know the right people. And if those right people get displaced from office, your entire business can come apart because there's your competitor. So it becomes cronyism. Internal capital markets can become cross-subsidization and cross-holdings. Because whenever you have internal capital markets, you're going to get cross-holdings as a side effect. It's not some conspiracy. That's the nature of the process. You know what I mean by subsidization? Company A lends to Company B. They're all within the same family group. Company A sets an interest rate. Actually, Company A doesn't set the interest rate. The family sets the interest rate at which Company A lends to Company B. Company B could be a very risky company, and you could make Company A lend to it at a 4% interest rate. So that capital markets now can become cross-holdings and cross-subsidization. And culture can cut both ways, right? So you can have a good culture permeate an organization, or you can have a bad culture permeate an organization with a family group company. It's very difficult if you have a cultural problem to make it go away. Right? You can't just fire the CEO. The entire family is attached to it. So there's a plus and a minus to family group companies. And we can debate whether the net effect is positive. In some family group companies it is, but it can become negative. So I'm going to use, don't even try to read the numbers here. Right? I'm going to tell you a story about the Tata Group, because I kind of introduced that story last week. This is about 3 years ago. I was in front of the Tata Group, CFOs, CEOs of the company, and I was asked to value some Tata companies. So I picked 4 of the 21 publicly traded Tata companies. How many companies did I say were in the entire group? 100, right? So how come only 21 are publicly traded? So what's true about the remaining 79 then? They're actually fully privately owned by the family. You can already see the potential for exposure you have as an investor in a publicly traded company, because when I do a transaction with one of those privately held businesses, God only knows what's exactly happening there. So I did a valuation of Tata Motors, Tata Steel, Tata Chemicals, and TCS, Tata Consulting Services. All 4 traditional valuations: an automobile company, steel company, a chemical company, and a software company. I'm going to show you the number that I want you to focus on here. When you take free cash flow to the firm and discount back at the cost of capital, you get a value for the operating assets, right? I did that for each of the 4 companies. And then what's the mopping up I need to do? I need to add cash, I need to add cross holdings, and I need to subtract our debt. Now, with most public companies in the US, those are, the cash might be big, but the cross holdings are not a big issue. Let me show you what my valuations look like for these 4 companies. See the blue component? That's actually my intrinsic valuation for these companies. Free cash flows of the firm discounted back at the cost of capital. See the red component? That's actually the value of the cross holdings in each of these companies. So when you buy shares in Tata Motors, you're buying half Tata Motors, and the other half is a portfolio of other Tata companies that you really don't even get to value, because most of them are private businesses. You're buying a pig in a poke. I don't even know what that means, but it sounds good. Okay. In fact, when I valued Tata Motors in front of this group, I came up with that value per share of, 644 rupees per share. Oh no, but that's not right. Where is it? Oh, 665 rupees. The stock was trading at 781. Sigh of relief that it wasn't undervalued. But the CFO of Tata Motors was actually in the front row. He said, 6 months ago the stock was trading at 520. Would you have bought our shares then? I'm on the spot now, right? So I had to tell him the truth. I said, I'll never buy a Tata Group company. He said, what? It's an entire group of Tata Group people. I said, buying a Tata Group company is like getting married, and the day after you get married, your entire set of in-laws move into the bedroom with you. I get along really well with my in-laws, but I don't want them in the bedroom with me for the rest of my life. That's effect. I want to buy Tata Motors. I want to buy Tata Motors. Instead, what do you saddle me with? A portfolio of other Tata companies, whether I like it or not. I said, I can't buy the stock, because the half that is Tata Motors, I can do the due diligence of estimating cash flows and cost of capital, but the rest is a brown paper bag you're holding up to me and said, trust me, it's worth 5 billion, 8 billion, 10 billion. So when you look at companies with cross holdings, and some of you will, you're going to come to this very last phase in your valuation where you try to come up with a value for these cross holdings, and what you're going to end up with is just the book value, what the accountant tells you these cross, it's a lie. But unless those cross holdings are publicly traded, what the heck are you going to do? So you can already see why cross holdings are an issue. Final point about emerging markets. There are some risks with emerging markets that you might not, emerging market companies, that you might not have to deal with as much with publicly traded companies. The first is natural disasters. Natural disasters happen all over the world, not just in emerging markets. But the difference is in developed markets, those natural disasters, you often have insurance against, so your company is not going to be catastrophically devastated, unless it's a company doing the payouts. I was in doing a valuation seminar somewhere in the Caribbean, way Antigua, some island that I couldn't even find. It took me like 3 hops and skips before I got there. And the entire audience was businessmen from the island. So as I go through the risks there, you talk about the interest rate risk, inflation risk, they're all, not mine. And then at the end of the process, he said, "Wilson, you missed a very big risk." I said, "What?" "Hurricane risk." Because many of these businesses are tourism related. One bad hurricane that could basically mean, and I said, "Don't you have insurance?" "Insurance is too costly. If we bought insurance, we would not survive as businesses." Natural disaster risk. So when I value these companies, what do I have to do? I have to be a weather forecaster. I have to take the farmer's almanac with me. Oh, no hurricane this year, therefore high value for you. But I have no choice, because if you have a natural disaster, your business is on the foothills of the Vesuvius, I would say, what is the next eruption going to happen? What's the expected cost of that eruption? Here's the value across natural disaster, no natural disaster. Related, of course, is terrorism risk. You want to value Syrian business? Go ahead. After you've done your discounted cash flow valuation, you've got to ask, what is the effect you're going to have? But because you're in a war zone, right? Your business, in a sense, can come apart. And finally, you can have nationalization risk. 30 years ago, this used to be front and center in half the emerging markets in the world. Thank God, that's no longer true. Now you're looking at a subset of countries. And usually these countries, you can name them, Argentina, Venezuela, and they shift in and out, because the minute you do this, you kind of cut your lifeline to the rest of the capital markets in the world. But in those markets where nationalization risk is a clear and present danger, these are all truncation risks, right? Just like distress risks. So what you need to do is estimate the probability of these risks and then ask, what will happen if I get nationalized? Because if you get nationalized, you're not going to get fair value. Otherwise, you wouldn't care. When you get nationalized, you might get half of fair value, you might get book value, you might get nothing. So that then becomes what you build into your valuation. Let's talk about financial service companies. Let's go through the questions. What are your cash flows from existing assets? I have no idea. Think of what? I have net income. What's CapEx? What's depreciation? What's working capital? Even coming up with the cash flow becomes difficult to do. When I ask you what the value from future growth is, if you can't tell me what you reinvested, I can't use that reinvestment rate times return on equity or whatever it is, because I don't know what you reinvest in. I have a very fuzzy idea of whether your value for growth is positive, 0, or negative. I actually have to trust you. Trust you when you tell me my loans are all good loans. I've set aside enough to cover bad debts. When you value banks, you're often trusting the banker to give you that information. When you think about risk, debt is no longer a source of capital. It's only equity. So when you talk about valuing banks, it always has to be equity focused. You can't value the bank and subtract out debt. You have to look at equity cash flows or cost of equity, end the game right there, because debt is no longer a source of capital. It's raw material. And for banks, the biggest risk you run is that if you violate those regulatory capital constraints enough, you might not be shut down as a bank, but your equity could be wiped out. The government could essentially step in and take you over. In the Deutsche Bank valuation, if you remember, there's a 10% probability that I attach. Not that Deutsche Bank will be shut down, but that the German government will step in and essentially provide the backing for the bank, but in return take away all your equity. It's a very different set of problems with banks. And I'm going to show you how I thought about valuing banks pre-2008 to start the game, and how that's shifted. And I've kind of given you an indication of how it shifted with some of the talk about cash flows. So this is actually a valuation, not pre-2008, but from last year, of CIB, which is an Egyptian bank. And with an Egyptian bank, I've used the old pre-2008 approach. And what I used to do pre-2008 is I used to throw up my hands and say, look, I can't estimate the cash flows for a bank. But I can look at the dividends. And I'm going to assume that banks are run by sensible people and they pay out what they can afford to in dividends. So the old rule for valuing banks is just use a dividend discount model. And for CIB, I use the expected dividends based on their payout. I estimated what their growth rate is based on their retention ratio, which is based on what they don't pay out, and their return on equity. So in other words, it's a very simple dividend discount model focus where the value per share that I get, which is about 42 Egyptian pounds, reflects the expected present value of dividends. Just if you pause and think about the dangers you're exposing yourself to there. If a bank is paying out dividends it can't afford to, which some banks do, right? Because their regulatory capital is actually going deeper in a hole, they keep paying dividends. You could end up significantly overvaluing the bank because you're so focused on dividends. In fact, in the last decade, a lot of value investors got sucked into that value trap with banks because they all had high dividend yields. If you were looking for 5%, 6% dividend yield stocks, often those were many big money center banks. Put all their money in, and guess what? 5 years later, you look, the prices dropped because those dividends were too high and they had to be adjusted over time. There's a dividend cut that came about that made those stocks more reasonable in terms of dividends, but undercut your valuation. So this is a conventional dividend discount model value, 2 stages of growth, so everything is essentially built around dividends. And that's the way I used to value all banks pre-2008. In fact, I'll show you a valuation that would have gotten me into serious trouble if I'd actually acted on it in August of 2008. I valued Goldman Sachs using a dividend discount model. Goldman Sachs in August of 2008 had an incredibly high return equity, paid very little dividends, and because it paid very little dividends and a high return equity, its expected growth rate was about 12%. So basically I took the dividends, grew them at 12% for the next 5 years. And then after that kind of scaled it down, so did everything you're supposed to do in a dividend discount model. The value per share that I got. And notice one of the nice things about dividend discount model valuations is there's nothing to mop up, right? No cash to add, no debt to subtract, no cross holdings to. How come I don't have to worry about all that stuff? Because dividends come out of net income, right? Net income already includes all this stuff. Implicitly, I'm saying, I don't want to worry about that stuff. I'm going to focus on the present value. The value per share that I got for Goldman Sachs was about $222. Stock was trading at 169. I should have bought. But I'm glad I didn't. Because 4 months later, you know what Goldman was trading at, right? It's trading at $75 per share. That's when Warren Buffett came into Goldman and took that large position. Because in the intervening months, you had the 2008 crisis, banks kind of melting down. And I remember somebody in 2007 sending me this valuation saying, how do you explain this value? And I said, I didn't see the crisis coming. Maybe you did. You have to value companies with what you have as your macro views then. But you can see how a macro shift can very quickly undercut your valuation because it effectively took away the basis for these cash flows. To me, 2008, the bigger lesson I learned was I don't trust banks anymore. So when you tell me you pay a dividend of $2 and you say you can afford it, I'm not going to take you at your word. I've seen exactly what you do. So post-2008, my big mission became I have to be able to estimate a cash flow for a bank. Because if I don't, I'm completely at the mercy of the dividend discount model. So you have to look past what they report and say, based on this, how do I come up with cash flows? And that is essentially, I'll come back to the how I came up with this free cash flow equity measure that I talked about in the context of Deutsche. So let me go through. You've had the net income that you can get for a bank, right? If you try to define reinvestment as capex, depreciation, and working capital, it's not going to work for a bank. So I had to come up with a measure of reinvestment from equity investors that would capture how much banks have to put back into the business to be able to survive and grow. And the only number to me that made sense was a regulatory capital number. So when banks invest in regulatory capital, they're not doing it for the good, from the goodness of their hearts or because they want to. They're doing it because if they did not do it, not only would they not be able to grow, they might not be able to survive. So the basis for this approach is coming up with regulatory capital ratios over time, regulatory capital requirements over time, and looking at the change in that regulatory capital as if it were the reinvestment. And already you can see the implications that emerge, right? If you're a high growth bank, you will have to invest more in regulatory capital than if you're a low growth bank. Why? Because that growth requires your capital to go up. If you're an undercapitalized bank, you got to reinvest more in regulatory capital than if you're an overcapitalized bank. So that's how I separate the two. And in fact, the other thing I used to do pre-2008 with banks that's gotten me into trouble is remember how we unlever betas and relever betas for traditional companies? I used to skip that step with banks. Why? Because I don't even know what the debt-to-equity ratio is with the bank. But implicitly when I do that, what am I assuming? That all banks are equally risky or equally safe because the regulatory guys have taken care of the risk. The other lesson we got out of 2008, the regulatory guys are taking care of none of that risk. I have to worry about the risk. So in a sense, I've got to take ownership of that stuff now. So what I'm working on now, and I'm not quite ready to unveil it, but you could probably beat me to if you want, is tying the cost of equity. So when you think about a risky bank now, what are some of the things that go into that statement that this is a risky bank? What makes some banks risky and other banks safe? One is you could be an Italian bank that absolutely refuses to tell me that half the loans on your books are not being paid, so it just stays on the books. So one worry about risk is, hey, maybe you're not telling me all the bad news. The other is that your regulatory capital has dropped to a level where I have to worry about new regulatory capital. So what I'm working on is actually tying the cost of equity to a bank to the quality of its loans and how under or overcapitalized. So I would expect an overcapitalized bank to have a lower cost of equity than an undercapitalized bank. I would expect a bank with more risky loans to have a higher cost of equity than one with safer loans. I would expect a bank that gets more of its profits from trading to be riskier than a bank that gets more of its profits from just traditional banking. So I need to kind of complete that story if I really want to value banks right, because if I keep discounting dividends at an average cost of equity across all banks, I'm going to end up with a lot of risky bad banks in my portfolio that look cheap but are really not cheap. Okay. The pages that I skipped is when you talk about the opaquity. Wells Fargo actually I valued on October 7th, right after the crisis. And I still stayed with the dividend discount model because I was still holding on to it. That's the only thing I knew. And the only way I could bring in the crisis was through the return equity. So basically I said regulatory capital ratios go up, regulatory capital ratios go up, return on equity goes down. Return equity goes down, holding all its constant, even within a dividend discount model, I'm going to end up with a lower value per share. In fact, I valued about $30 per share. It was trading at 33. It had dropped from 53 to 33. I thought it was going to be a bargain when I sat down to start the valuation. One of those few cases where you actually get a surprise from your own valuation saying, it doesn't look that cheap after you've adjusted for the higher regulatory capital needs and the higher risk in this process. So if you want to start, if you're valuing a bank, if you want to start with the dividend discount model, go ahead. It's a good place to start, but don't stop there. Stop and ask the question, look at the regular, and those are all public, that's all public information. You go into Capital IQ, you can pull up the tier 1 capital, tier 2 capital, every regulatory capital definition for your bank and the rest of the peer group. So you can at least see where it falls in the spectrum across banks. Any questions on financial service companies? So here was a valuation of Deutsche in the good old days, when it actually was an undercapitalized bank. I'm sorry, an overcapitalized bank. It actually had a regulatory capital ratio higher than the rest. It's exactly the same framework I used in 2016. The difference was in 2009, Deutsche was healthy in terms of its regulatory capital. So I didn't have to reinvest as much regulatory capital to keep it going. So my free cash flows equity were actually positive. When I revalued Deutsche in 2013, it was already starting to show the symptoms of its problems. Its regulatory capital had dropped, partly because I had to take these big write-offs. That's one reason regulatory capital drops. So in 2013, when I valued Deutsche, I had about $6 billion in free cash flows to equity over the next 3 years to get back to its required ratio. If you looked at my 2016 Deutsche valuation, you add up the cash flows, I now have $20 billion in negative free cash flows equity in the first 5 years. That's how deep the hole is. Partly because of the fine that the Department of Justice, the $14 billion fine that might become $10 billion, and partly because they're already undercapitalized. They need $20 billion in new equity, and that's basically draining their value. The $13 per share would have been $22 per share if the regulatory the $22 per share would have been $35 per share if they did not need that regulatory capital inflow for the next 5 or 6 years. So any questions in general about banks? Yep.
The same framework for
Yeah, in fact, I use these for banks, for insurance companies. The capital definitions for insurance companies, at least in the US, are messy because they're state-based, depending on which state your insurance company is in the regulatory. So it's a mess because you also actually have to figure out what that regulatory capital is based on, which state the insurance company operates in. So it's messier, but you don't get the wide variations in regulatory capital of the insurance companies that you do with banks. Now let's talk about valuing companies with intangible assets. The biggest problem here is the accounting, right? Because there's nothing really different about a tangible versus an intangible asset from a cash flow perspective. They both generate cash flows. What do I care that one I can see and the other I cannot? But when you start asking questions, what are your cash flows? What's the value of growth? How risky are they? You're stuck with accounting statements that mess up those intangible assets. In what way? If you have a lot of R&D, accounting right now treats it as an operating expense. So when I look at your profitability, I'm looking at an operating income number that's really not the right number. When I look at your book value to see whatever you invest in your businesses, because you're expensing your R&D, your biggest asset is off the books. So almost every question here, if I leave the accounting statements as is, I'm going to get a very misleading view of a pharmaceutical company, a technology company, in terms of its risk, the value of its growth, its cash flows, and when I make it a mature company. So to get this process rolling, you have to fix the accounting. That's why we spent as much time as we did when we did cash flows correcting for R&D. Correcting for R&D doesn't change your free cash flow, but it does change your views on what's the invested capital, what's the return on capital, what's your reinvestment rate for this company. So I'm going to go back and take one of these companies just to show you the impact all the way through the value. But this is an issue not just for pharmaceutical companies. I would argue it's an issue with brand name companies. That big advertising expense, part of it should be capitalized. For human capital companies, consulting companies, accounting firms, that a big portion of your value comes from human capital, I'm messing up the valuation because the accounting doesn't sync. So here's what I did. I went back and I looked at Amgen. I gave it a 10-year life. So I did the capitalization of R&D. So we went through this process of what to do, right? Fix the life, go back and collect R&D for the last 10 years, write it off over the 10 years, and keep track of two numbers, I said. First is how much you're amortizing this year, $1,694 million, and what the remaining unamortized portion of the R&D is. Let's see how this plays out in your numbers. So if I left the numbers with unadjusted, basically take the accounting numbers as given, I start with net income. The accountant tells me that Amgen made $4.2 billion, but if I correct for R&D, it looks like they actually made $5.5 billion. They're more profitable than they look when I capitalize R&D. Their book value of equity, if I trust the accountant, is only $17.9 billion, but if I capitalize R&D, the book value becomes $31.1 billion. The R&D capital gets added on. My return on equity, if I trust the accountant, is 23%. But if I capitalize R&D, that drops to 18%. Not bad, but not as good as I thought it was. My pre-tax operating income jumps from 5.59 to 6.93 billion. Book value of capital increases by the R&D. My return on capital goes from 25% down to 19.7%. The company is more profitable than I thought it was, but it's making a lower return than I thought it was, and now you can see how it tilts your valuation, right? My base year number is going to be higher, but the value that I attach to growth is going to be lower. And from my perspective, I'm getting a much more realistic view of the company when I do this. I'm going to show you the valuation that I got with my capitalized R&D. Okay? And if you've seen my spreadsheets, it's one switch, right? Yes, no. So if you make it yes, the R&D gets capitalized. So it gets capitalized, I adjust your operating income, I adjust your invested capital, your return on capital, your reinvestment rate. So this is with my perspective on R&D. The value that I got per share was $74 per share. Stock was trading at 55. And this is actually a stock I bought. It still is in my portfolio. So the last 3 days have been nightmarish for me because I've lost about $20 the share price because one of their drugs went under. But it's now at 140, so I shouldn't be complaining. $74 based on treating R&D as a capital expense. So after I finish the valuation, I had a question. How much of this is coming from my quirky treatment of R&D? An accountant look at this and say, you shouldn't do this. What if I turn the switch back to no? The minute I turn the switch back to no, the numbers all go back to the original accounting numbers. So I'm going to ask you to guess, without looking at the next page, whether my value will decrease or increase when I don't capitalize R&D. So I will have lower operating income and higher return on capital. So on the one hand, my base year number will be lower. On the other hand, I'll give you a much higher value for your growth. The only way to find out is just let it play out. And here's what I've got. If I turn off the R&D switch, and you should try this, if any of you are capitalizing R&D, just as a what if, turn off the R&D switch, see what it does to your value. In the case of Amgen, my value went from $74 to $43. Don't generalize from this. Don't assume that for any company, when you turn off R&D, the value will drop. In the case of Amgen, the value dropped. When I did this for Merck, I got a higher value with the standard accounting numbers and a lower value when I capitalized R&D. Why do you think that is? What am I learning when I capitalize R&D that's leading me to increase the value for some companies and decrease the value for others? What does capitalizing R&D do? Basically, it treats R&D like any other capital investment, right? And when does investment add value? When you earn more than your cost of capital. So if you do a lot of R&D and it doesn't pay off, which is the Merck case, when I capitalize R&D, I destroy you as a company. I'm saying, you have to stop doing this. Because every time you spend on R&D, my cash flows decrease, nothing happens in the future. In the case of Merck, capitalizing R&D reduced my value. At least in 2012 or 2013, maybe even earlier than that, 2007, when I valued Amgen, capitalizing R&D increased the value, which tells me that at that point in time, their R&D was productive, was earning a return on capital higher than the cost of capital. 2015 was the last year I valued Amgen. It was still creating value, but the value creation has shrunk. The return on capital in Amgen, once you capitalize R&D now, is about 11%. Remember it used to be 18%? It's now 11%. It's still higher than the cost of capital. But across all big pharma companies, the return on capital has now dropped below the cost of capital. R&D has become value destructive at much of the old-time pharmaceutical businesses. That's not good news in many ways, right? Because it means that that the focus on R&D will start to, and many of them are trying to bypass this by buying biotech companies, doing acquisitions, but the game has changed in the drug business. Some of it is company related, some of it is macro, right? Healthcare law changes, the pushback against the rising cost of drugs, all are playing out as lower returns on capital and lower profitability. Last piece, at least I'll get started. Cyclical and commodity companies, the biggest issue is if you just look at 1 year, you could get any number. If it's up here in the cycle, the good economic year, high prices, oil prices. So everything you see for your company will reflect when you look at the company. So your oil company in 2014 looked really good. In 2016, it can look really bad. The company itself might not have shifted, but oil prices have a huge effect. So the solution to this is a fairly straightforward one, right? Which is if oil prices go up and down, you don't want to be going up and down with those prices. You want to get a sense of what's a normal price. And here's the challenge we face today. Getting a normal price for a commodity has become a nightmare. If I just take the last 10-year average, well, the normal price is much higher than today's price. If I take a 50-year average, the normal price might be lower than today's price. So normal is in the eye of the beholder. And if you think about these companies, what often tends to happen is what you think about the company will reflect what you think about the commodity. In other words, if you think oil prices are going to go up to $75 a barrel, every oil company you value will look cheap to you, not because you like the company, but because you think oil prices are going to go up. Let me ask you a question. If you're that convinced oil prices are going to go up to $75 a barrel, is there an easier way for you to make money? Why the hell are you valuing ExxonMobil and Lukoil? Just go buy oil price futures and go to sleep. Why waste your time on companies? If you have a strong macro view, you're welcome to it, but don't build it into every company valuation that you do, because then I'm not sure how much you like the company and how much of this is coming from the macro view. So I'm going to close today's session by talking about how to deal with this, because there's no way around it, right? You cannot value an oil company without a point of view on oil prices. So I'm going to close with a company that's a mature oil company where the key variable driving its value is going to be oil prices. Okay? And I'm going to use a statistical technique that I find useful with these companies, which is I'm uncertain about oil prices. You're asking me for a point estimate. My answer is I have no idea. So the company I'm going to use is actually Royal Dutch Shell. one of the largest oil companies in the world, with a split personality. Half of it lives in the Netherlands, half of it lives in the UK. There are other parts of it, kind of half and half is one, but this is like multiple. It's like a split personality. Company that's been around 100 years. I value the company on the, I'm going to call it an oil price neutral valuation. Basically, I value the company on the assumption the oil price, when I value the company, which is about $40 a barrel, would be the oil price going forward. So I'm saying I'm not comfortable taking a point of view. I came up with a value of $39.31. In doing this valuation, here's how the current oil price played out. My existing oil price, I actually had to replace the base year earnings with an estimated earnings, because in the most recent 12 months leading into the valuation, oil prices had averaged $50 a barrel. They dropped to 40, so I knew that wasn't right. So I'll show you how I normalized the earnings. But the valuation is based on the assumption that oil prices today are in fact the right prices. Am I certain about that? Of course not. In fact, I'm really uncertain about oil prices. The variable that drives Royal Dutch's value is oil prices. This is actually one of the most, if you're a Royal Dutch manager, this graph is the most depressing graph you can ever look at. Because it gives you about 25 years of revenues at Royal Dutch and the average oil price each year. So basically, the bars are the revenues. I just did an R squared between the two numbers. It's 96%. Let me ask you a question. Who's the CEO of Royal Dutch? I don't know and I don't care. Because what the heck is he going to do? In fact, this is a company that's a pure oil price play, right? Because if 96% of your movements come from oil prices, who the heck cares who runs the company? In fact, I took the revenues and regressed them against the oil price. An extraordinarily useful tool at this point, because now if you give me an oil price, I can tell you what the revenues will be given that oil price. Because it's all driven by oil prices. So here's the last thing, I know I'm running over, is I made the oil price a distribution. Use crystal ball, right? So instead of using an oil price of 40, I made it a distribution centered around 40, and then I made the computer go pull a price out of the distribution. Could get 72 or 25. I computed the revenues based on that oil price. I valued the company with that revenue. Then I redid it and did it again and again and again. Crystal ball's default is 100,000 simulations. Here's what I ended up with. A distribution of Royal Dutch values per share. So I'm no longer giving you a value per share of $39.50. I'm giving you a distribution. The median value is about 37. Could be worth only $7 if oil prices go to $10, $15 a barrel. It could be worth 197. You're saying, what do I do with this? The stock price is, let's say, 50. You can now tell me that the stock is overvalued, but you can tell me more. You can say there's a 31% chance it's overvalued by counting the number of valuations above 50. You can give me a lot more information on which I can base my investment decisions. So you don't have to do this on your DCF for Friday, but you have, is crystal ball still available to you guys? If you get a chance, just play with it. For the moment, just put in a distribution, make up the parameters. It'll be garbage in, garbage out, but it'll be great looking garbage. Right? Try it, because it's a tool that we don't use enough. So I will see you on Monday, and I'll put up the review session after class today. Oh, one more thing I forgot. We will be starting on packet 2 on Monday. So if you're buying it at the bookstore, packets 2 and 3 are one packet. If you're printing it off, print it off as packets 2 and 3 separately.
Just a quick question. So in the investment in regulatory capital, you mentioned that was a change in book value of equity. So does that include other changes that are not related to the investment in the, because I guess when I look at the breakdown of the equity base, there's no explicit reference to an investment in regulatory capital.
But remember, book value of equity, the only thing that makes it change from year to year is retained earnings, right? So you don't have to worry about any of the specific items.
Okay.
Retained earnings goes into book value of equity, increases the book value of equity. Retained earnings also goes into regulatory capital, increases the regulatory capital. The reason regulatory capital and book value of equity can deviate is Tier 1 capital actually allows you to count some other stuff as part of regulatory capital. Most of the stuff is hybrid equity.
Yeah.
So it doesn't show
So
up as
it's
book
for-
equity,
yeah.
but it should really be book equity.
So I can use then just the change in retained. And in terms of estimating, I guess though, I saw in your Deutsche valuation, you just estimated your risk-adjusted assets out, like you just grew them out.
Because it's a mature company. But if you're
Okay.
a growth bank, that's where it shows up. So if you expect a 10% growth in your
Right.
risk-adjusted assets, your regulatory capital requirements will have to grow up faster because you're. So that's your chance if you have a high growth bank. That's the place I would show it is through the risk-adjusted assets.
Okay, great. Thank you.
Professor.
Yes.
I'm valuing Pfizer, and how should I treat all the pipeline, the drugs are in the pipeline, like phase 1, phase 2? So should I use like options or?
Maybe too messy. You can't do it. Basically, just bring it in.